Nikhil Vora from IDFC will join in on the show. Sudeep Bandopadhyay as well as with us, and so is Sandeep Patle. Nikhil, I want to start off the discussion with you. Markets always look forward. How much of the pain is already in the price? Because when the turnaround will happen, these stock prices would have turned around before the absolute reality.
I am not too sure whether really you'll see a V-shaped recovery from here on. I think the fact is that you've got into a structural, a lot of the malaise that you look at today is self-inflicted in some sense, and that's unlikely to change in a big hurry. We've been sensing this out for the last 6 months odd, where our sense is that, investors may as well as remain on the sidelines. This is not the market of 2008-9, where you saw extremely sudden spike and reversal. My sense is this is a gradual pain market. And like I said before, if markets show you an all-time high and all-time low at the same point, you've got to worry a lot more, which is what it is. So I would much rather for once play on the sideline, not really indulge too much, not as a trader, not as an investor. Either side, I think it's becoming extremely, extremely difficult because the visibility of businesses is getting extremely murky. And give or take 5 to 10 stocks in the Indian market right now, which might still continue to show a decent sense of back-ended growth. I think the broader markets are not. And valuations in that 10 stock bucket is pretty much at levels which are possibly taking the next 2-3 years of growth into account. So my sense is that we may as well as play the reversal when you start to see the first sign of changeover, rather than now preempting that changeover. So we are pretty much cautious, extremely cautious, and rather do think that investors in general will get a much better entry point in the Indian market.
Sandeep, today the good part of the market has got hit. IT stocks have reversed, and there were no takers for consumer names.
Absolutely, Nikunj. I think that is the worst that has happened. That it clearly shows or means that there is some more downside. Now even the stocks or the sectors which have been, which are holding for such a long time, they are on the selling side. Specifically the way HCL Tech and TCS cracked, and also a Lupin, and as well as a Sun Pharma, that does not augur too well. And I think at higher levels it is clearly evident that at higher levels selling is bound to resume. So even if we hold 5500, 5400 for the time being, I don't think we'll cross above 56, 56.10, and that is a level where I think one should again go short.
Sudeep, hi, evening. What is your sense about the correction that we saw in the FMCG names today? Is it time to book out of the names like a Unilever or an ITC?
Well, Aisha, Unilever, I think investors should have booked out quite some time back. At current valuations, Unilever is extremely richly valued, and if they haven't already booked, they should book. A P multiple of the kind Hindustan Unilever is enjoying right now is completely unrealistic. So yes, the correction was due and overdue, and if somebody is holding HUL, I think our recommendation has been to book and wait for it to come around 550 levels before re-entering. It's an excellent company. There's per se no problem with the company whatsoever. It's just that the valuations are too rich to justify based on the sales number which we are seeing quarter on quarter.
Okay, Tata Motors numbers came during the market hour, and brokerages will react to these numbers only tomorrow morning. And I don't think based on these numbers, brokerages would really change or they would downgrade the stock too much. The JLR piece of the business is still doing well. For JLR, margins have expanded. The clear concern is the domestic part, and for the domestic part of the business for Tata Motors, there are multiple challenges. They've lost market share in the passenger car market. CV sales have plummeted, and even the new launches have not crystallized anything big for Tata, have not crystallized into anything meaningful for Tata Motors. So based on Tata Motor numbers, what they've reported for the quarter gone by, do you think the stock is unlikely to do anything special in the near term?
Not at all. I think stock is going to remain where it is. Range between 250 to 300 is where Tata Motor is stuck and is going to remain there. Look, Nikunj, pretty much everybody in the street knows that domestic business is not going anywhere. The whole concern, if I may say so, is pertaining to JLR and how JLR is going to fare in China going forward. There are some concerns being expressed in some quarters that Chinese political leadership is clamping down heavily on conspicuous consumption, and we are hoping and praying that JLR doesn't become victim of that clamp down. If that doesn't happen and JLR continues to get the numbers what they're getting in China, I think Tata Motors as a whole will continue the way it's continuing. Recovery in India is still some distance away, and I don't think you should put any bet on Tata Motors which banks on recovery in India.
Sandeep, want to get you in on the charts of Lupin as well as Ranbaxy. Post the earnings, how are they stacking up?
Well, I would wait for some kind of an up move in Lupin to sell, but definitely it is a sell. I mean, nearer levels of 850, 860, I'm very comfortable selling Lupin. It's given a clear breakdown. And on the downside, I think 780, 790 is very much likely in Lupin. Ranbaxy has given a breakdown much earlier, I mean around 320, 330 levels. And at 270, 260, I think there can be a bounce back. One can sell in the range of 310, 315 if it comes, and then play again for a target of 270 or so. So at this point in time, I think Lupin is set for a bigger correction. Ranbaxy may consolidate.
Sudeep, how would you approach IT stocks now? There is definitely some sector tailwind there. That there are two ways to approach IT stocks, I guess now, Sudeep. One, it's an overcrowded trade, one should avoid it. Or B, there could be a case of serious P expansion in IT stocks. Just like a P expansion we saw in FMCG stocks in earlier part of this year, do you think we could see a similar P expansion in IT going forward?
Absolutely right, Nikunj. I agree with the second part of your analysis. I think Indian IT sector is probably in for a PE expansion, but one has to remember that it doesn't apply to all the small cap and mid cap IT companies. The PE expansion will probably be limited to the large cap universe. And I think that's going to be the case. Look, what's happening today, most of these companies have a significant business coming from US, and US definitely has recovered from where it was in 2009, 10, 11. So US markets have become buoyant once again, and the IT companies are getting more and more job. Yes, there are visa issues. Yes, there are some, the rate issues. But having said that, I think the business from US is going to come in. Second part, rupee depreciation definitely in the long run helps. And irrespective of whatever our view on rupee may be, the fact is rupee was at towards close to 50, and now it's close to 60. If not, it further depreciates. So very clearly there is an upsurge or upside available to the IT companies, particularly the large cap IT companies who are managing their business well. And I will definitely point out TCS, HCL in this list. They are definitely doing right things. Infosys is trying to get back, so is Wipro. So we'll have to watch carefully Infosys and Wipro. But TCS and HCL at every drop, I think is worth looking at for buying.
What is your sense, Nikhil? Do you think growth will remain with the names from the IT pack at least? Because the currency denominations as well as the US recovery seems to be working in their favor. So besides today's profit taking, do you think they would still stand still?
Well, the fact is that, the irony is that Indian market have very, very rarely been a value market. It's always been a growth market, and invariably, we as investors have always tended to pay a lot more for growth than value. Growth rate, albeit at a lower level, still seems to be slightly more visible in businesses like IT, pharma, consumption, a bit of oil and gas. So I think, as long as that level of growth continues to remain visible, we will end up paying a slightly more higher value for a suboptimal growth. IT clearly does stand out right now, purely because you are playing a developed market proxy through IT right now, and you're also playing emerging market weakness through IT, which is again the dollar appreciation. So I think IT could continue to remain possibly a protected sector for some time right now.
Sandeep, do you think it is pointless to discuss the importance of 5,500 on the Nifty? Because in key individual, mid and small cap stocks, the breakdown has already happened?
Not really, Nikunj. 5500 and 5400 are 2 points. 5400, according to me, is far more important and far more stronger in terms of a support. 5500 for the last 2 days has been held on. It is not being broken. So we can't, till it is broken, we cannot, though yes, I would agree that there are all signs that it will be broken, and we are presuming that, let's not do that. But good chances it will be broken. But I am closely watching 54, as I have been saying time and again, because 54, once it is broken, then the fall can be accentuated and can come in very, very fast. I mean, from 54 to 48 could be a matter of probably a week or two. And that is what my biggest fear or worry is. I mean, if it doesn't break, if it holds 5400, we'll spend some time between 54 and 56. And I hope that then there will be some kind of a support coming in.
Let's look at some weekly charts. Asian Paints, HDFC, HDFC Bank, HUL, ITC. Now these are FI dominated stocks, and the force with which some of these FI dominated stocks or quality stocks have cracked, I'm just getting some kind of an impression that now the long-term stakeholders of Indian equities are panicking. And the reason why this is happening is because emerging market growth has got challenged. There are no clear solid underpinnings which would really galvanize flow back into emerging markets, and within the emerging market basket, growth expectations for India has got reset. Now when we started the year, there were two things which differentiated India from others. Number one was hope that Indian economy will recover, and B, a very strong consumption oriented or a very strong demographic supported economy. Currently growth has got reset and consumption seems to be slowing down. Sudeep, do you think now the long-term shareholders, the long-term stakeholders of Indian equities are panicking? The force with which HDFC Bank, Asian Paints, Bosch, all these quality names have corrected, I'm just getting some kind of a feeling that classic FIs are getting out.
Nikunj, you are right to an extent, but I won't use the word panic. I would rather say they are worried and they're watching the developments very closely. You are absolutely right in saying that the expectations from India haven't been met. On the contrary, I think most players couldn't have imagined this kind of a mess which we have created for ourselves in our economy today. And they are extremely worried, and they are trying to take some profit from the table. And I think that's getting demonstrated by the fact that these counters, where most of the FIIs are sitting on huge profit, they are selling and booking some profit. Well, whether they will completely panic and exit these counters, specifically the ones you just mentioned, I think it's unlikely, because if they have to remain invested in India, probably these are the best bets. So I don't think they will sell and get out. But yes, they are booking profit, and yes, they are extremely worried.
Cracked below the 5,500 mark, only to recover just a smidge, so red tick nonetheless for the day coming in. Banks held out, and of course high beta, beaten down names as well did spring up in trade. But what trades should you execute come tomorrow morning? Navneet is waiting by with the list of stocks to watch. Navneet.
Well, Aisha, one buy and one sell call coming in from the dealing room, starting off with Reliance Industries, which surged over 3% in today's trading session. Dealers are indicating some fund buying has been taking place in this particular counter. Also, if you look at the fundamentals, with rupee depreciation, Reliance Industries stands to gain because your oil and gas prices are determined in dollar terms. So keep an eye on that counter. The other stock is HDFC, where dealers are recommending to go short on this particular counter because the institutional holding is high, and they are indicating that the institution could trim their exposure to this particular counter. Today also you saw some pressure coming in. Targets have been cut down by a few of the brokerages. The stock was down by over 3% in today's trading session. Well, if you look at the YTD return for HDFC, that's high by about 12%.
Right, Navneet, thanks a lot for that. Sandeep Agle, what are your top ideas for tomorrow morning?
We have been talking of Lupin. I would have a sell in Lupin on every bit of a up move, maybe 10-20 rupees. A stop loss of 850, target of 790. A sell in HCL Tech, which showed weakness today. A stop loss of 930, a target of 885.
Sudeep, are there still any value buys in today's market scenario?
Of course, Aisha, I think, all markets you'll find opportunities of value buy. There are some companies which we are banking on right now. One is such companies, Bayer Crop Science. I think, this number one agrochemicals company, great parentage, great balance sheet. With monsoon being right, I think the demand for agrochemicals is going up. And with this kind of name, with this kind of parentage, if you're willing to wait for some time, which is 1 year plus time horizon, I think a price of around 1600 is definitely on the cards in about 6 months to 1 year time.
Nikhil, final question. What is your take on banks? Up until now, banks have led the market decline. Do you think they are unlikely to lead the market decline any further?
Well, if there was one big concern right now in corporate India, which is how do you really kickstart the economy and whether there are adequate private sector who's willing to play that role, I think that reigniting investments is the biggest challenge because the existing investment is into significant strain. And I can say that with some certainty that right now private sector investment appetite is pretty much at possibly the lowest ebb that you would have seen in the last few years. The current investments are pretty much over-leveraged and demand curve is pretty much non-existent, which means that the strain for financials will likely continue over the near term. For the first time, you're also starting to see banking sector as a whole starting to exert a lot more pressure on their existing disbursements. So you've seen a fair bit of corporate group get into strain. And my sense is that if you start to look at interest rate looking to harden up or remain where they are, and maybe a quarter or two of demand pain continuing, I do think that you will see disproportionate pain still being there in financial sector because lot many of corporate groups in India which are over-levered are bound to get restructured, refinanced, and maybe at some point also get classified as NPAs. So I think financials are in for strain, unlikely to change in the very near term, which could be the next 6 months or so. And I think till the time you don't really see monetary policy really reverse track and corporate India sentiment start to improve, I don't really see too much of merit of investing in financials right now.